Investing Basics, Mutual Funds. Welcome to our comprehensive guide on mutual funds. We'll explore everything from basic concepts to advanced strategies. Mutual funds offer a gateway to financial growth for both beginners and seasoned investors. What is a mutual fund? Money pooling. Investors combine their funds into a collective investment vehicle. Securities investment. The pooled money purchases stocks, bonds, and short-term debt. Professional management. Experienced fund managers make investment decisions for the pool. Types of mutual funds. Equity funds. Invest primarily in stocks. Higher risk with potential for greater returns. Suitable for long-term wealth creation. Debt funds. Invest in fixed income securities. Lower risk with stable returns. Good for capital preservation and regular income. Hybrid funds. Mix of equity and debt. Balanced risk-return profile. Perfect for moderate risk takers. Money market funds. Invest in short-term, liquid instruments. Lowest risk with modest returns. Ideal for emergency funds. Benefits of investing in mutual funds. Professional management. Expert fund managers make informed investment decisions based on research and market insights. Diversification. Spread risk across multiple securities to reduce impact of poor performers. Affordability. Start investing with as little as 500 rupees through SIP options. Liquidity. Redeem your investments quickly, usually within 2 to 3 business days. How mutual funds work. Net asset value. Price per unit, calculated daily by dividing total fund value by units outstanding. Fund manager's role. Analyzes markets, selects securities, and manages the portfolio to achieve fund objectives. Unit transactions. Investors buy units at NAV plus applicable charges and sell at current NAV. Performance tracking. Returns are measured by NAV growth plus dividends distributed to investors. Active versus passive mutual funds. Active funds. Professional managers select securities to outperform a benchmark index. Higher expense ratios. Potential to beat market returns. Greater research involvement. Frequent portfolio adjustments. Passive funds. Mirror a market index like Nifty 50 or Sensex with minimal intervention. Lower expense ratios. Returns match benchmark index. Minimal research required. Infrequent portfolio changes. Understanding mutual fund fees. Total cost impact. Compounds over investment lifetime. Transaction charges. Entry/exit loads when buying or selling units. Expense ratio. Annual fees for fund management and operations. Even a 1% difference in fees can reduce your returns by lakhs of rupees over 20+ years. Always compare expense ratios before investing. Choosing the right mutual fund. Define your financial goals. Determine whether you're saving for retirement, education, or other specific objectives. Assess your risk tolerance. Be honest about how much market volatility you can handle without panicking. Consider your time horizon. Longer time horizons can withstand more risk for potentially higher returns. Research fund performance. Examine consistency of returns over 3, 5, and 10-year periods against relevant benchmarks. Systematic investment plan. Regular investments. Fixed amount invested periodically. Rupee cost averaging. Buy more units when prices are low, fewer when high. Long-term wealth creation. Harness compounding through discipline and time. A monthly SIP of just 5,000 rupees can grow to 1 crore in 20 years at a 12% annual return rate. Start early to maximize benefits. Tax implications of mutual funds. Fund type. Short-term capital gains. Long-term capital gains. Equity funds. 15%. 10% above 1 lakh rupees. Debt funds. As per income tax slab. 20% with indexation. ELSS 15%. 10% above 1 lakh rupees. Dividend distribution. Taxed as per investor's income tax slab. Risks associated with mutual funds. Market risk. Overall market conditions affect fund value regardless of individual security selection. Interest rate risk. Rising interest rates typically lower debt fund values, particularly for long-term securities. Credit risk. Potential default by issuers of bonds or securities held in the fund. Liquidity risk. Difficulty selling securities at desired time and price, especially in stressed markets. Evaluating mutual fund performance. Benchmark comparison. Compare fund returns against appropriate market index over similar time periods. Alpha. Measures excess return over benchmark. Higher alpha indicates superior fund management. Beta. Measures funds volatility compared to market. Beta of 1.2 means 20% more volatile. Consistency. Look for funds consistently in top quartile performance over 3, 5, and 10 years. Regulatory framework in India. SEBI formation. Securities and Exchange Board of India established as market regulator. Minimum capital required for asset management companies to operate in India. Transparency. Mandatory portfolio disclosure by all mutual funds every month. Investor protection. Size of investor protection in education fund maintained by SEBI. Common mistakes to avoid. Chasing past performance. Yesterday's winners often underperform tomorrow. Past returns don't guarantee future results. Ignoring expense ratios. High fees eat into returns silently over time, significantly reducing wealth accumulation. Poor diversification. Concentrating investments in similar funds increases risk without improving returns. Frequent switching. Constantly moving between funds leads to higher costs and missed recovery periods. Conclusion: getting started with mutual funds. Begin with clear financial goals. Consider professional advice for personalized strategies. Start small with regular SIPs. Stay invested for the long term. The power of compounding works best with patience and consistency. How to start investing in mutual funds. Join our expert-led webinar and master the essentials of mutual fund investing, from selecting high-performing funds to building a diversified portfolio tailored to your financial goals. Our seasoned financial advisors will provide actionable insights, address your specific investment concerns, and equip you with strategies to navigate market fluctuations with confidence. Reserve your spot today. Webinar access link available in the description below.